Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about incomes and property price growth. You see, commentators often refer to price of property in Australia relative to household incomes. And they highlight that property prices have grown at a rate 2 or 3 times faster than what household incomes have grown, and they conclude that property growth cannot exceed household income growth perpetually, which of course at a macro level no one can really argue with mathematically. It has to level out at some point. Now, I've written about previously the things that I think have contributed a lot to property price growth over the last 30 or 40 years. And there's a link to that blog in the show notes and on the blog on the website, of course. And the main contributors really, or a really large contributor, has been borrowing capacity, deregulation of the banking industry, which created a lot of competition, and therefore also the internet, kind of advertising to people or educating people about, investing in property and borrowing capacities and these sorts of things. And I think that they've contributed a substantial amount to property price growth because really, whilst your income might have not changed in real terms over the last 30 years, your borrowing capacity certainly has. And that has obviously a positive impact on prices. But I don't think a lot of these things that have contributed towards property price growth over the last 30 years, except for perhaps population growth, I don't think they'll be present for the next 30 years. So, and certainly from a borrowing capacity perspective, I think that's either going to stay steady, but it's certainly not going to have the same sort of increase over the next 30 years as it has been over the last 30 years. But in any case, the commentary around income growth and property price growth, again, might make for interesting conversation at a macro level. But I think it is far less relevant to people that are willing to invest in investment-grade property. And my thesis is that you should invest in locations that attract the wealthiest 20% of Australians. And if you do that, you're likely to enjoy above-average capital growth over very long periods of time. Now let's talk about wealth inequality. I mean, wealth inequality really means the rich get richer, and unfortunately, the poor get poorer in both real and relative senses of the word. It makes escaping poverty a lot more difficult. It robs people of opportunities. And really, it's a terrible thing. Wealth inequality is a terrible thing, particularly if it's getting worse and worse, which it certainly is in most developed countries around the world, and Australia is not an exception to that. I charted, in fact, the extent of wealth inequality in Australia using 2021 data, and it shows that the wealthiest 20% of Australians own 73% of total net personal wealth. So it's almost the 80-20 rule. It's almost 20% control 80% of the wealth. And as I said, it gets worse each and every year. And it would be lovely to think that, Australia is going to do something to apprehend the tide of wealth inequality, but I think, unfortunately, that's really unlikely. And wealth inequality is likely to get worse, not better. And if we think about more recently, for example, COVID really exacerbated it. Higher income earners were typically able to continue working from home. They enjoyed almost zero interest rate, zero cash rate, of course. And a greater capacity to be able to save, whereas lower income earners, tend to have lost their income. Their businesses were closed, and now they've got to deal with higher interest rates and higher inflation, which really again just makes the poor poorer and the rich richer, because higher inflation is far less of a problem if you've got a very high income or you have substantial wealth. Now, putting aside the societal or humanitarian considerations of wealth inequality, which are, of course, significant, I don't mean to diminish them whatsoever, but really if we're talking about making investment decisions, I think it's really prudent to make those investment decisions based on the premise that wealth inequality is likely to get worse, not better. And if that's true, then property price growth in blue chip locations that really attract the wealthiest 20% of Australians will likely materially exceed, outer suburbs that don't attract, that attract the remaining 80% of Australians, if you like. So what does that mean? Does that mean you should go and look at all the stats and invest in the suburbs where the occupants have a above average income compared, based on ABS data and so forth? Well, that would be logical, right? It would be logical to skew your investments towards areas where there are a lot more higher income earners because they're going to start pushing up prices and so forth. Well, I read a very interesting article by Jeremy Shepherd, which he's a data analyst, and he sort of highlighted some of the shortcomings of relying on that data. And I think, investing's not just about, data and looking at data and these sorts of things. And I've written previously that investing in property requires an approach that's almost equal parts art and science. The science element relates to the data and the analysis, all the sort of objective considerations. However, relying on data and analysis alone is too risky because not all data is reliable, nor is it meaningful. Data can be out of date or not representative of the factor that you're trying to measure, and so it's only kind of half the picture. Whereas the art element is the property know-how, including understanding the market, what buyers are looking for in a particular location, being expert in a geographical location, and so on. It's all the subjective matters. So, for example, sometimes there's no objective reason why some streets in otherwise great suburbs perennially underperform. Sometimes it's that way just because it's been that way for many years, and there's no rhyme or logic to it. It's just that knowledge and know-how. That's the art element, the subjective elements, and it's equally as important as the objective. So really, investors need to have a balance, a perfect balance, if you like, between objective and subjective considerations when selecting which property to invest in. And it's not that income is not important, it's just that it's not always representative in the data and there's some constraints around it. And so that's why being too data-driven is going to invite you to end up making a asset selection mistake. Now, of course, in a rising tide, all ships rise. Therefore, if you invest in a buoyant market, in a buoyant market, most properties tend to rise in value almost irrespective of their location. However, of course, we know that we're investing for the long term, and we know in the long run, the location will drive the returns rather than the market per se. That is, the underlying quality of any investment, is one of the biggest determinants of, future long-term returns. And so we know that if we're going to invest in an area that attracts the wealthiest 20% of Australians, that cohort has a lot of resources to continue to pay more to be able to own property and live in that particular location. See, the wealthiest 20% either have above average incomes, they could be asset rich, or then they'll eventually benefit from what I've written about and spoken about previously, the inheritance tsunami that's coming our way over the next few decades. Either way, they're in a position where interest rates don't make as big a deal, that inflation doesn't have as a bigger impact on their financial decision making, and they're really in a position where they can push prices higher over time. Now, wealth inequality, we know it's not going to be a trend that's going to abate at any time soon, and so my thesis is that you must consider that when making investment decisions. So that's it for me this week. A bit of a shorter one for this week, so I hope you appreciate that. You don't need to listen to me prattle on too much. And until next week, bye for now.